The sudden collapse of Silicon Valley Bank in March led to the government's swift and speedy action to prevent a disastrous contagion. The Federal Reserve now publishing its internal review of its supervision of SVB, all while First Republic Bank is reportedly most likely headed for Federal Deposit Insurance Corp receivership. This according to CNBC's David Faber. Joining us now to discuss the banking sector stresses is former FDIC Chair Bill Isaac. Thank you for joining us this morning, Bill. I mean, when we look at the predicament that, especially now, First Republic is in, I mean, what would a rescue look like at this point?
Well, it's too early to say exactly what they're going to do. They really have two choices. One is to find investors or other banks, perhaps, to invest in First Republic and take over the control of it and the management of it. That's possible, and they're going to have to put some money in, and that's probably the hardest part, is for a private sector firm to put money into a bank who's in the shape that this one is in. The other opportunity is for the government to step in and take over. And if I were betting, I'd say that's probably the direction this will go, but you don't know until they actually get it done.
And obviously, we have this heightened awareness about the bank closures, especially, in light of what we saw with social media going back and forth when everything first started to go down. I do want to draw your attention, though, to IBM's Vice Chairman Gary Cohn, because he weighed in with some context on the bank closures. So I'll have you take a listen and then I'll get your reaction.
Every year, we lose banks out of the U.S. banking system. So, since Dodd-Frank, I think since the Dodd-Frank legislation after 2008, we've lost over 10% in the banks of the United States. So we've had this slow grinding, whittling away of banks in the United States. I think we're more acutely aware of what's going on now because we've seen larger banks, much larger banks, run into financial trouble, and we've seen larger banks go out of business. I don't think we have seen the end of this banking situation. I won't call it a crisis because I don't feel like we're in a crisis.
And so then, is this a situation where perhaps if we weren't so hyper aware of it, that we perhaps shouldn't be as concerned about First Republic?
I think that's reasonable, not to be over concerned about what's going on. We've actually been in a consolidation in the banking industry for the past 50 years. When I was chairman of the FDIC in the late 70s and 1980s, we had 13,000 banks at the beginning of that period. At the end of that period, we had lost 5,000 of those banks. So I think that's what happens when you go from a highly regulated industry, highly protected. The banks had their own market. Nobody else could be in it. And interest rates were controlled tightly on deposits and on loans. So you had a highly regulated, protected industry, and we have moved into a more open market industry, one that has lots of competition and competitors, more than just banks, but non-bank financial firms. So I think that there's a fallout. There's a consolidation of the industry that's to be expected. The important thing is to make sure that it happens in a way that protects the interests of the banking public, and I think we've done that so far pretty well.
And most analysts agree. Look, obviously SVB did need to be rescued in terms of contagion, but I know you take issue with how they went about it. And we just had a graphic up there about some of the FDIC reforms that you would like to see, including stop bailing out all depositors when a bank fails, improving and better targeting of deposit insurance coverage for these larger depositors, cover 100% of all non-interest-bearing checking accounts held at these failed banks, clear some of these unnecessary operational inefficiencies at the top of the FDIC. And you say if they do all that, then Congress would not need to have the President and the Secretary of the Treasury then authorize the FDIC and the Fed to have these bailouts. If there was one priority which you think should perhaps lead the way here with the reforms, what would it be?
I have trouble coming down to one, because that's a package that I presented that I think fits together nicely. And obviously, we need to have more depositor discipline from the largest depositors, and we also need to protect those largest depositors so that they don't lose all their funds, because when they lose all their funds, you impact the entire community around the bank. So I tried to put together a proposal there that is a good compromise. It provides some discipline for the largest depositors, but yet it keeps funds in the community so that the community doesn't suffer unnecessarily, and employers don't suffer, and their employees don't suffer, because we protect the demand deposits of banks, the funds that are there to make payroll payments and keep the community going. So I think that if we doctor this and protect this deposit insurance system in an appropriate way, we can go through these bank failures with a lot less trauma, lot less drama and trauma.
So then, we're looking at still First Republic, their shares were halted at one point today, continuing to sell off though. But at what point should the Fed and should regulators say, look, this bank should be allowed to fail? Because obviously they're thinking of systemic risk, moral hazard, all these different thresholds. At what point do you say enough is enough and really let a bank fail?
Well, I think we should be doing that more often. But when we do, that's why I've suggested changes in the way the deposit insurance system operates, because if we do let those banks fail, we do need to protect the people that need to be protected when that bank fails. For example, we protect all depositors that are under $250,000 because we feel that the smaller depositors don't have the means to really examine a bank and be careful about where they're putting their bank and so forth. Where the larger depositors, they can make those judgments. But even on the largest ones, we shouldn't take all of the money out of the system. We should leave most of it there. I suggested that we pay 80% of the largest depositors, 80% of their money immediately. It comes from the Fed immediately, and then the FDIC will reimburse the Federal Reserve. And then as we collect the assets of that bank, of the failed bank, and we recover some of that 20% of the bank that the depositors did not get, then we give them that money as well. So they may wind up losing nothing. They might have to wait for a while. So it's things like that, and covering payroll accounts so that innocent people who weren't even depositors in the bank are able to get their payroll checks and not have them taken from them. If we do things like that, then a bank failure is not the end of the world. It's a relatively minor disruption, and it clears out banks that don't belong in the system. And I think that if we do something like that, we'll have a much better banking system, in my judgment.
We'll certainly see how this plays out and hopefully see some of those reforms tighten up the system as well. Bill Isaac, thank you so much for joining me this morning. Have a great weekend.
Thank you.